Hello everybody, I want to give you this video so you could get ready for the test on tomorrow, exam 6 in microeconomics. There's some special instructions that starts off, and if you're interested you can kind of write your own answers to any of the problems that you have. What I did is I took the test itself, removed the answer choices, we're just going to work through it. Although there's several questions that have these 5 choices as the answers, so you want to familiarize yourself with all 5 of these terms: diminishing marginal utility, asymmetric information, adverse selection, agency problem, and moral hazard. You want to think of examples of each of those so that you'll recognize them when they come. Actually, which starts off with insurance questions, but there's several questions that have one of these as the correct answer. Let's take a look at question 1. Here's Hugo. He's contemplating a potential loss of $100. He believes there's a 75% probability that everything will be fine. So what we do there, since he will not lose the money 75% of the time, he shouldn't pay more than 25% of $100 for insurance. The most he should be willing to pay for insurance, therefore, is $25. Question 2. If XYZ Insurance Company offers $1 million life insurance for $1 million per year, the actuaries at XYZ must believe that I'm going to die. Number 3. Which economic principle explains the behavior of individuals when they are first interacting with one another and behave cautiously until they know one another better? And that, if we go on up here, is really the idea behind asymmetric information. People act cautiously until in the face of asymmetric information. Number 4, which economic principle is illustrated by a person who knows they have an increased risk of loss and seek out insurance because they're more likely to submit a claim? That is an example of adverse selection. Number 5, Milton Friedman is quoted as saying, "Nobody spends somebody else's money as wisely as he spends his own." Which of the economic principles applies this notion to politicians as well as employees and contractors? You think about it, what contractors, politicians, and other people, when they're spending other people's money, are really exhibiting the agency problem or the principal agent problem. We come on down here, number 6. Sawyer has just purchased a $100 electronic device and is considered buying the warranty that goes with it for $20. And which of the following conditions would be the least compelling rationale towards buying the warranty? There's a lot of different choices I give you on there, and some of them are choices that you hear people say, but what you want to do is think about a rational reason to buy the warranty. Why would Sawyer pay $20 for a $100 warranty? And while they might say, well, he has the money on him, that wouldn't be a good rationale. Or it'd say, well, it's only 20 bucks, something like that. That would not be a good rationale. What we want to do is think about his chances of loss and whether they're greater or less than 20%. And that's what would be the most compelling reason. So any reason that gets far and away from anything that makes any sense or rational decision means that it's the least compelling rationale. People might give a reason, but it's not a rational, thought-out, cost-benefit economic reason. Question 7. How is healthcare different from other goods we consume? Actually, questions 7, 8, and 9, you can find these repeated at the end of the PowerPoint presentation on chapters 18. And you might have some of these about labor are found at the end of the PowerPoint presentation on chapter 15 as well. Healthcare is different from other goods we consume, for instance, because insurance acts as the payer, and it is separate from the decision maker who's deciding whether to go to the doctor or not. What's a reason to explain why healthcare is such a large portion of GDP? It's because of the Medicare, Medicaid, and things like that that come into play. Suppose you pay insurance premiums but do not get sick. What happens? Well, the insurance company just keeps your premiums, uses it for something else, goes to profits, pays for other people that did get sick, things like that. How could the problem of adverse selection in insurance markets be solved? One of the ways that we thought about it is where we could use Carfax or some kind of information, like doctor information, so insurance companies would know what to charge you for health insurance if they knew more about your health concern. But I don't think that's a choice there. I think that they're looking at making everyone pay means that there is no selection between those that have low risk and those that have high risk. Everyone pays for the insurance. Which of the following situations illustrates an example of moral hazard? Well, you'll have to find one based upon your understanding of moral hazard. But what you're looking for something that would cause people to change their behavior because they've got, let's say, insurance. And now we move on to number 12. Suppose the United States took the extreme step to enact wealth redistribution programs until income was equal for all people. What's the most likely result? Well, we would expect that if people didn't receive more or less, regardless of what their behavior was, we would get some people out there that would be free riders, that would live off of other people's productivity without contributing themselves. And we'd expect an overall decline in productivity in the country. Here's Charlize. She pays $1,000 per year for $100,000 compulsory liability insurance on her car with no deductible. The cost of the same insurance with a $100 deductible is $950 per year. So because she's willing to pay an extra $50 per year so that she wouldn't have to come up with a $100 deductible in case of an accident, that tells us that she thinks it's worth $50 to have a $100 insurance policy, the deductible portion of the insurance. That tells us that she thinks there's a 50% chance or better that she's going to cause an accident and need to come up with the $100 deductible. Question 14. The demand for labor, which is a derived demand, meaning it's a result of the increase or decrease in demand for whatever it is that labor produces. So for instance, if the demand for labor will increase if whatever labor makes has an increase in demand as well. Number 15, a firm will keep hiring workers as long as the wage paid to workers is less than the marginal productivity of labor. What is true about outsourcing? Well, outsourcing creates new markets for labor in new areas like India, and it has a negative impact on demand for, let's say, domestic labor. Suppose Raphael can rent a lunch cart for the day and will have the following revenues and expenses. The number of lunches he's planning on selling is 100 for the day. He's going to have to spend $24 for every lunch that he makes, which is a flat rate inclusive of all economic costs except the cart rental. And the price he's going to sell his lunches for is $30 a piece. So he is going to have 30 times 100 in revenue, which is $3,000, but he's going to have $2,400 in expenses. So that'll give him an economic profit of $600 if he can have the lunch cart. If he doesn't get the lunch cart, he won't make any economic profit. So based on the information provided, what's Raphael's maximum willingness to pay for a lunch cart rental? He's willing to pay up to $600 for that rental and not more than that, because then he'll be operating at an economic loss. If he can get the lunch cart for less than $600 a day, then he'll be making some economic profit. For instance, if someone gave him the lunch cart to use for the day, then he'd make $600 in economic profit. Question 18. Earl recently went on a spring break, and before he left, his Uncle Joe told him, "Just call me if you run out of money, Earl. I'll wire you enough to get back home." On the last day of Earl's vacation, he did run out of money, and he called his Uncle Joe for help. What economic principle would have predicted this eventuality? They say, all right, well, here we are. Because Earl had a backup plan, because Uncle Joe said he'd bail him out in case he ran out of money, it's not surprising that Earl spent all his money. He wouldn't have done that if he didn't have his Uncle Joe promising to back him up. And that's a very example of what we mean by moral hazard. All right, changes the way people behave because of the backup plan. And it's now, which is the correct spelling of bourgeoisie? How about entrepreneur? The actual test question asks you to spell a word that you've been seeing all year long, and you need to figure out which of the four choices is the correct spelling for that word. Now we go on to the auctions. Question 20. We have the Codex up for auction. We have the Gutenberg up for auction. These are the four people that show up for the auction. Ringo's got 85,000, Paul's got 100,000, George has 60,000, John has 90,000. This is how much each one of them is willing to pay for the Codex. This is how much each one of them is willing to pay for the Gutenberg. The bidding begins at $1,000 and keeps rising by $1,000 until only one person is left to buy. And you are the auctioneer. You have a choice. You're trying to maximize revenue, so you can either put the Codex up for auction first, or you can put the Gutenberg up for auction first. So what I've done over here is kind of worked it out. This is not going to be on the test, but I have it over here so you can see. If we put the Codex up for auction first, it'll sell for $71,000. I believe Paul wins it, and because Paul then spends $71,000 out of his $100,000, he doesn't have enough money to bid on the Gutenberg, and that means the Gutenberg ends up going to George for $56,000. The total would be $127,000 in revenue if you do the Codex first. If you did the Gutenberg first, then Paul would win the Gutenberg because he would win it for $61,000, but then he wouldn't be able to bid that high for the Codex, and that would mean the Codex would be won by Ringo for $61,000. That would generate only $122,000 if you did the Gutenberg first. So, question, what's the maximum revenue from this auction according to these parameters? And the answer would be the maximum could be 127. You can't do better than that, 127,000. Question 21, what's the marginal benefit of auctioning these two items in the correct order? Well, if you do it in the correct order, you make 127,000. If you do it in the incorrect order, you only make 122. So the marginal benefit of auctioning the two items in the correct order is an extra $5,000 for doing it the right way. And that's what we mean by marginal benefit. Great question. I think it's really useful. Now, we've answered both those questions. I'm just going to take a second here and try to explain how we figured out that the Codex goes for $71,000. What happens is the bidding begins at $1,000, $10,000, $20,000, and since all of the people here have enough money to go up to their, up to $20,000 or $30,000, then they all are in the auction until it gets to $41,000. At that point, John decides he doesn't want the Codex. So then it's a race between Ringo, Paul, and George. But George is the next one to drop out because he's only got $60,000. Even though he knows the Codex is worth more than that, he can't bid more than he's got. So he drops out at $61,000. And then it's a duel between Ringo and Paul. Ringo's willing to go up to 70, Paul's willing to go up to 80. They both have enough money to cover their maximum willingness to pay. So as soon as it gets to 71,000, Ringo drops out. He doesn't think the Codex is worth that, and that's why Paul gets it for 71,000. As I said before, because Paul spends 71 of his 100,000 on the Codex, it leaves him with only 29,000 left over to vote on the Gutenberg. So he's the first one to drop out when they are auctioning off the Gutenberg, when you auction off the Gutenberg next. And what we see is John drops out at 51,000, and it just becomes a duel between Ringo, who's willing to go up to 55,000 and has the money, and George, who's willing to go up to 62,000 but doesn't have the money to go more than 60. So George is able to get some consumer surplus. He's able to buy the Gutenberg for 56, which gives him 6,000 in consumer surplus because what he values it at compared to what he buys it at, and it was a close one because he really didn't even have the money to pay the full price for the Gutenberg if it had gone that high. And that's how we figured it out. You work it the similar way by doing the Gutenberg first and then the Codex according to this list. Let's move on. Just a few more questions on the test. One of them is the Woodstock voter sentiment in upcoming elections. The voters were polled to determine which candidate would get their vote based on the main issues of crime and pollution. The two candidates are polarized on the issue. Jerry is thinking about different things, and what I did is I just kind of gave it to you this way. So here's Hillary, whose vote is positioning herself here in the election, and here's Ben, who's positioning himself here in the election. And if we take a look at this, Hillary would win these 4 votes plus those 6, those 10, those 8, and that's 4. If we add all that together, we get 32 votes for Hillary on this side, plus she would get these 4, so she'd make 36 votes. Ben, on the other hand, would get these 8 votes, these 12, these 2, and these 10. 8 and 12 is 20, plus another 10 is 30, 4 more is 34. So Ben would get 34 votes, Hillary would get 36 votes. Who would win the election if it were held today? Hillary would win 36 to 34. So which change in position would be optimal for a candidate to take in this election? If you're Ben's campaign manager, you'd say, Ben, you ought to move over here. If you did that, then now you can take the half of the people that Hillary has, and you'd also keep all of the same people you had already. That would mean that she would drop down to 34 because she'd lose 2 of those middle votes, and Ben, you would pick up 2 of those votes. And so moving to the middle would, maybe 36. Sorry, I put it in the wrong direction. So now Ben would win by positioning himself here. So that's the idea. What change in position would be optimal for a candidate to take in the election? It would be, in this case, the median vote, the 50-50 seat. All right. Then we go to the last question here that's on this review sheet. We've got 6 cities. We've got 6 different costs of campaigning or advertising in each of those cities, and 6 different benefits of advertising in those cities. You're in charge of your company's advertising this quarter. What's the most revenue generated from an optimal allocation of $6 million campaign budget when the above markets are available? So where should you spend your advertising campaign dollars? It's tempting, of course, to go right up here to the $12 million for 2. And that's because for every million you spend in Boston, you get $6 million here. So you definitely want to spend 2 of your $6 million in Boston and get 12. And then if you spend the choice, really at that point, Erie is out. Detroit is still a possibility, and that would give you 8, but you can do better than 8 by spending, let's say, 3 and 1 would give you 12 additional dollars, so you get 24 million by spending it in Boston, Cleveland, and Bush. Can you do better than that? Well, we could, of course, do Boston, Albany, and Bush, and that would give us only 23 million, and since we have an extra million, that's not going to be enough. So when you work it out, you're thinking about it that way. One way to analyze these problems is to figure out what you're getting as a ratio. Here you're getting 4 million benefit for each million spent. Here you're getting 6 million benefit for each million spent. Here it's 3 for 1. Here it's 2 for 1. There it's 1 for 1, and there it's 3 for 1. Then that makes it easier to pick out which ones are the highest utils per dollar. Sorry, your benefit of the ad, more sales per dollar spent. Thank you very much. I hope you enjoyed the review session. You have good luck on the day, and have a very merry holiday.